At the Reserve Bank's November board meeting, the board decided to lift the cash rate by 25 basis points. That had been our forecast until we saw the September quarter inflation report, which we thought was a game changer. What we saw in that report was that underlying inflation lifted to 1.8% in the quarter, compared to general forecasts of 1.5%. But more importantly, we saw that the spread of inflation pressures had become much more widespread than before. And it appeared to us that businesses in particular were embracing inflation psychology, and we're seeing that it was becoming much easier to raise interest rates. We thought that as a result of that momentum that we saw, that the inflation pressures in the next 6 months were going to be significantly higher than had been expected in the past. So for instance, for the March quarter next year, we did think that underlying inflation would be running at an annual pace of 5%. We're now expecting 6.4%. As a result, and given the precedents that we've seen around the world where central banks responded to inflation shocks by lifting the intensity of both their rhetoric and their decisions, we thought the RBA was likely to follow in the same mould, particularly as they emphasised that they are very much data dependent upon their decision making. But of course that did not happen. They raised the rate by only 25 basis points. And the risk that they were going to do that was always that back in the October meeting, they surprised the market by pivoting from 50 basis points to 25 basis points. So the idea of switching back to 50 was going to be quite unpalatable, and that's what turned out to be a key factor behind the decision. Embedding the risks that we're now seeing on the inflation front, the Reserve Bank lifted their forecasts. So they now have inflation at 8% this year, up from 7.8%. But most significantly, in 2023, they've lifted their inflation forecast from 4.3% to 4.75%. And in 2024, they now do not think that they'll get inflation back to the 2 to 3% band, arguing that by then inflation will still be above 3%. The risk in raising those inflation forecasts and not making a decisive move at the November meeting is that this inflation psychology becomes further embedded in the system. When we raised our forecast for the November meeting from 25 basis points to 50, we lifted the terminal rate from 3.6% to 3.85%. That reflected the 50 basis points in November, but also the higher near-term inflation profile. That near-term inflation profile is still there, and indeed the risks are that it becomes even more intense, given that we didn't see that decisive response yesterday. So we retain our 3.85% terminal rate, but instead of the last hike being in March, we now expect it'll be in May, because that March quarter CPI for core inflation, we expect to print around 6.4% annual compared to 5%. So when that report is received in time for the May board meeting, we think it's unlikely that the Reserve Bank would be able to go on hold. So we now have 25 basis point moves in the next meeting in December. February, of course, there's no meeting in January given the Christmas break. March and then May for a terminal rate of 3.85%. The Reserve Bank also indicated that they lowered their growth forecasts from 1.8% in 2023 to 1.5% and 1.7% in 2024 to 1.5%. That's pretty much in line with our forecast that we've had for some time, that growth in 2023 would be only 1%. And the way we see the profile in 2023 is that in the first half of 2023, there'll probably be some momentum that we're seeing still maintained in the economy. Bear in mind that this is an unusual cycle. The unemployment rate is near record lows. Households have accumulated about $250 billion in savings, and we're still seeing the reopening effect, particularly in New South Wales and Victoria. So there will be some momentum going into the first half of next year, but we expect by the second half the economy will probably stagnate. Now, with that stagnation, we believe that there will be scope for rate cuts in 2024. We're a lot more confident about that when we thought there'd be a preemptive strike against inflationary expectations at the meeting yesterday, which would mean that the inflation profile in 2024 would be conducive to rate cuts in 2024. That still remains our view because we do have a lower inflation profile than the Reserve Bank in 2024. However, the risk now is that because the inflation momentum is stronger and we're only seeing these 25 basis point movements, the risk is that 2024 might be a stronger inflation number along the lines of the Reserve Bank's own forecast, which would make it much more difficult to get that interest rate relief in 2024. And it was really about getting that relief was one of the key factors behind the need to have a preemptive strike on inflationary expectations now to ensure that by the time we get to 2024, those inflation pressures have eased, allowing scope for rate cuts. Thank you.